Rent control is crushing the Twin Cities, and who's next? Imagine this, a city votes for rent control to help struggling tenants. That seems like a great story, right? But 4 years later, new apartments are vanishing, developers are fleeing, and rents in uncontrolled units are skyrocketing. That's exactly what happened in the Twin Cities of Minneapolis and St. Paul, where rent control backfired hard. Stick around because in the next few minutes, I'll break down how rent control destroyed their housing markets, which major developers pulled out, and which cities are next in line to repeat this stupid mistake. This is all backed by real data. There's no spin. So let me take you back to 2021, and the Twin Cities were so eager to pass rent control because they wanted to help the citizens. And that's really where a lot of these great ideas start. Hey, how do we help Paul and Sammy stay in their house? How can we make things more affordable? Hey, I tell you what, let's pass rent control. Let's lock in the prices and let that evil landlord only get a 3% rent bump every year. Hey, that's a great idea. Well, us evil landlords that are capitalists, because we want to deploy capital, we want to return on the capital, we want to put that back into the market, we want to do things. We look at that and we go, hey, I'm not going to build new apartments in that area. Well, if there's still people moving into the area like was happening in the Twin Cities, you got a problem. If I'm not building new units because of your policies, then all of a sudden the ones you have, people get locked into. They're there for life. They can never move. Now, that doesn't seem too bad, except that they can't ever make the jump from a rental to a house because now houses are going up because they're scarce. Developers are switching their lane. They're going from developing apartments to developing subdivisions and building houses. The other thing that happened is outside those areas that were locked in rent control, rent wasn't controlled. So developers moved to those areas. They began to build in those areas. Those rents skyrocketed because it was the only place you could find something to rent, and that became its own problem. Now with scarcity, the balance between supply and demand gets out of control, and when there's no supply and demand is high, prices do what prices do. I mean, Ferrari does this in the best possible way. You know, I love the quote that says, Ferrari doesn't do TV ads. Why? Because the people that they're trying to reach with their message aren't sitting in front of a TV. But the thing that Ferrari does is there's scarcity. There's only a certain number of these cars. They're not mass producing them like Ford Motor Company. Now, Ford has its lane, it's got its niche, that's great, but the reality is Ferrari, everybody knows Ferrari is a symbol of handcrafted. It's a symbol of a very high standard and a very low number. So Ferraris tend to keep their value, and they tend to not have too much trouble getting their $300,000 plus purchase price because the supply and demand that they keep in check to make sure the market doesn't run away with them. But here's the thing. If I want you to be incentivized to develop in an area, I'm going to give you incentives, not take away incentives. So if a city needs something, cities can't build housing. Cities can offer initiatives to those that do. Counties, states, federal government can all offer initiatives. But if, from a developer's perspective, if I'm going to be locked in for the total lifetime of my asset to only get 3% rent bumps, that's going to cap my growth permanently. It doesn't matter what asset class there is. We're seeing 3 to 5% rent growth is normal, but we always sell in different cycles. We always look at that and say, hey, I have a 10-year deal on an industrial deal. I have locked myself into 3% rent for 10 years. But in year 10, the tenant has the right to renew the lease. I have the right to set the rent rate. So in year 10, there will likely be a bump up in rent that will probably be 10 or 12%, and then we will set that same thing that will cap it at 3% for the next 10 years. So if I do the math and I'm going to deploy $100 million into an apartment complex, and I know that I'm only going to get 3% rent growth, I can do that kind of rent, or I can do that kind of appreciation in something like VOO. I mean, I could do that in a mutual fund. I don't need to take all the other risks that are involved in the math of building a new construction deal. So the reality is when I look at that and I say, you are limiting me, you are locking me in, I'm not gonna do that. I'm gonna go take my project somewhere else. I'm gonna go deploy that capital somewhere else because this project all of a sudden doesn't pencil. And when I've only got 3% rent growth, I don't know where my interest rates are gonna be in 10, 15, 20 years when I'm trying to exit the property or when I'm trying to do a cash out refi. So if I've locked myself in, I know what the maximum my rent can grow, but I don't know what my interest rate can do. So I may find myself in a position where 10 years from now, my mortgage has gone up 2%, my rents have only gone up 3%, my expenses have gone up 1%, and I cannot refinance the property. Or I can't refinance it with the cash I have in, so I have to bring more capital. This is asinine. Nobody is going to do that. Nobody's going to want to do that deal. And Minneapolis and St. Paul are walking, talking examples of investors and developers just leaving. So if you're a developer or an investor trying to avoid policy landmines like this, I put together a free resource that you're going to want. It's called the SRI Due Diligence Framework. It's how we vet every deal, and it walks you through how we analyze markets, the risk factors of those markets, and the policy red flags in those markets before we deploy capital. Grab it. It's free in the link in the description below. So let's talk about impact. How severe was the drop in new development across St. Paul after that vote? Well, it was really severe. In fact, hundreds and hundreds of units just disappeared overnight because it took all of the availability that was coming right off the table. Now, if you were mid-stroke on building the deal, well, I guess you kind of had a decision there. Are you going to continue and finish? And a lot of them did. So there was some new supply, but nobody's bringing new. Now, the policy that was actually designed to help lower income tenants, it didn't work the way it was supposed to because now everybody was fighting for those units. And if I'm a landlord and I'm supposed to look at this and say, hey, I have two tenants, one makes $3,000 a month and one makes $5,000 a month, and I can only get a 3% rent bump. Who am I gonna go with? I'm gonna go with the guy that's making $5,000 a month. He's got better credit, he's got more disposable income, he's got all of the things that tell me that he's going to pay my rent on time. So the lower income tenant is gonna get cast by the wayside. So now the whole group that it was designed to help is actually the one that is suffering the most. This is what actually happened in Minneapolis, St. Paul. So now you've got all of this stuff going on. You've got developers leaving, you've got product going on. And here's the other thing. Let's say that you've owned this apartment complex for 10 years and you're coming up on the fact that, you know, tenants aren't as happy to rent your place. The carpet's 10 years old, the cabinets are 10 years old, the pool is kind of, you know, it's whatever. I'm not gonna put any more money into it because now you don't have a choice. You're either gonna rent mine or, oh, that's right, there's nothing else to rent because nothing new is being built. So now I'm going to continue to put less and less and less effort into it, meaning that I'm going to basically manage this property into a slum because putting money into it doesn't get me more rent. So now you have properties becoming of lower value, properties that are actually falling apart, and nobody coming to replace new, so there's no competition for me in the Class B that becomes a Class C that then becomes a Class D. So I've mentioned all of these things because it sounds like a great policy and it looks good on paper, but it really doesn't help those that it was designed to because it's not a well thought out economic policy. It's just one that they put together and happened to put out there. So we lost Minneapolis, St. Paul, they lost mixed use developments, they lost multifamily developments, and here's the thing that nobody's talking about. They lost all the ancillary income. So when I'm hiring a framer to frame new buildings, he's making money. He's spending money in the economy, at the gas station, at the grocery store, buying a new car, buying tools, all of those things. That's sales tax money. That's money into other businesses. That's money that goes into the economy. So it really hurts the whole economy. And this is not just a situation that's isolated to Minneapolis and St. Paul, but it's happened in Portland, it's happened in New York, it's happening in California. Oregon, Washington. We've got a project that we bought in Washington when rent control wasn't even on the boards. We're trying to get out of it, right? Because we know that this is not going to be the same thing. But here's what we saw this last year. We were allowed as landlords to take a 10% rent bump. Now, 10% rent bump, okay, at least they were a little bit generous. It wasn't locked in at 3% like Minneapolis and St. Paul. But every landlord took 10%. Why? Because they could. And the reality was next year, if we only took a 6% this year, we don't get the 4% next year when property taxes escalate, when the cost of getting the grass mowed has gone up substantially. We're locked in. When insurance goes up, we don't get to pass that on. So we're all taking every penny of that 10%. So now we have locked in a march toward 30% over the next 3 years, and everybody's doing it, and that's stifled the investment in new buildings there. So we have adjusted our strategy in a little sense of the word, but we've always tended to stay out of rent control markets. We've never liked them because we don't want the government to tell us what to do, because we don't want them to have control of our capital. But the reality is this is something that has happened again and again and again. We saw this in 23 when rents on buildings came down. We saw this in Austin, in Dallas, in Houston, in Nashville, right? Where a lot of apartments were being built because there was a lot of demand. And then the market got flooded. And then the rents came down. And now that product is getting absorbed. And now rents are starting to climb again. So capitalism has its own way of sorting things out. You don't have to rely on the government to regulate that and kill future developments. So we look for those red flags. We look because they start with landlord unfriendly laws, and then they move on to actually capping the amount of rent that we get. So you want to look for these red flags before you enter a market, because it can be fatal. It can be the death of your project. It can be the death of an area, as Portland has proven, as Minneapolis, St. Paul has proven, and these red flags are known in the industry, and they're very, very obvious. But if this story shocked you, watch this next one, because it also talks about Portland just passed policies that could destroy its middle class and push thousands of people towards homelessness. Click here to see what's happening and what to do about it.